I think in general, we've got some pent-up demand from consumers who have been in their homes or in their rentals and are really wanting to get into homes. And I think the general sense of those who are buying and returning to market are, let me jump in before rates drop too far and pricing jumps up because of the shortage of inventory. So consumers who understand that, I think, are more jumping in. We are seeing multiple offers, but not 10 and 20. We're seeing 2 to 5 in the hot markets or in the certain submarkets. People understand they can refinance if rates will fall, but clearly the Fed has sent a message that they're not going to be dropping as quickly as we had anticipated.
Hi, everybody. I'm Matt Fowler, Executive Director of Triangle MLS, and we are here for our quarterly statistics call with the University of North Carolina, Keenan Splagder School of Business, and a few people from the Triangle staff. We've got Andrea Syracuse, our Director of Communications. John Wood is a longtime member of the Triangle Board of Directors. And we also have Jim Spaeth here with the University of North Carolina and some of his colleagues.
Yeah, appreciate that, Matt. And we're grateful for this partnership with Triangle MLS and your team. I'm Jim Spaeth, professor within the Keenan Flagler Business School, focused on real estate finance. I've got with me today the rest of our team. Actually, we're missing one member. I'll introduce him as well in absentia, but we've got Professor Jacob Sagi, teaches real estate finance for us. Professor Eric Maribojoc also teaches real estate finance and leads our housing affordability initiative within the Wood Center for Real Estate Studies. We've got Professor Roberto Quercia, who is a longtime faculty member within the planning area and a great contributor to housing scholarship over the years. And then we're missing today Professor Jeremy Moulton, who's in our public policy department. Jeremy also studies housing issues and is at a housing conference as we speak. So he's increasing the knowledge of our group and will be joining us next time. But we're grateful to have access to this data. We see our role in this, Matt, is looking at what you all are giving us, combining that with information that we have at our disposal, and then hopefully providing your listenership and viewership with some insights into what's happening in today's housing market. So we're excited to have this conversation today.
Thanks, Jim. That's exactly the idea, that he's out, learning about housing. I was at a housing conference yesterday in Chicago, but they don't really overlap. Like, we look at the market in just different ways fundamentally, and it's really interesting, as we were just saying in the setup. I think that's where the learning happens, where we talk about the way we look at housing, and then you bring in a different perspective. And we've been doing this for, I guess, almost a year now with our internship program and looking at the data together, and I've found it extremely useful. I hope people who are watching this, policymakers and, zoning commission people out there struggling to make a decision, get something out of it. And if there's something we're not covering in these calls, we'd love to hear from people who would like to, see what we should be focusing on. Affordability is certainly a huge one. I think we had somebody in the waiting room, just say in terms of housekeeping, if you have access to that, Andrea. And we're actually, while we're talking to Andrea is our Director of Communication, and she's driving the deck today. She's probably going to chime in and ask some of the questions that I forget about. And this is a collaboration between the two organizations. So I'm going to, just let anybody who has a comment about these slides chime in. I know John spends a lot of time thinking about these rates. I know there's been a little bit of a tick up in the last week or so. And there was a post from the NAR economist yesterday saying, while there was hope that there would be some cooling this summer, it appears that we could be in the high sixes and even tick 7 again here going into the summer. This is tea leaves prognosticating about the 10-year Treasury, but that's such a driver for affordability. So it's something really to start with.
Yeah, I think, Jacob, you've looked at this pretty extensively. You want to share some thoughts here?
Yeah, absolutely. I guess I was waiting for my cue.
That's it.
So yeah, I mean, notwithstanding the optimism, dare I even say exuberance of the equities market in terms of growth in the United States, the fact that we have been able to avoid a recession so far, the much feared recession that was being forecasted all the way back in early 2023, et cetera, all the talk of soft landing, et cetera. The data seems to tell us that the driving force behind higher interest rates, which is inflation, is more persistent than a lot of market players have hoped. And if we look at various forecast indicators that are out there, and this is one, but there are many others, and they all more or less point towards the same thing, which is we need to brace ourselves for interest rates staying higher for longer. Now, what does it mean higher for longer? You can see that here in the chart. The 10-year Treasury yield is being forecasted to hover around 4% for the next few years, maybe even beyond that. Now, from a historical perspective, this is not an outrageous level of interest rate, but when we compare it to the kinds of interest rates we experienced post global financial crisis, and that covers the span of a lot of people's working lives, and certainly a lot of folks who are in the position of considering purchasing a home, these are high rates. So, of course, this is going to translate that 10-year Treasury yield is essentially a benchmark on which a lot of other long maturity types of lending obligations are based. And so, if we can go to the next slide, we can also see that the 30-year fixed rate mortgage rate commensurately is also expected to stay high. And here again, we're talking about sixes, mid sixes, maybe low sevens. We have to understand that, again, these forecasts are, they are to some extent reading the tea leaves, but it's the entire market, more or less consensus, reading the tea leaves. And so, again, we have to brace ourselves for that reality over the foreseeable future. And by that, I mean for the next few years.
Yeah, I think it's the contrast, right, against the rate that we just experienced, this long, slow, artificially cheap money just had an enormous effect on the economy, on multifamily and all of that building that we've seen. And the contrast is just the shock, I guess, that people are experiencing. You think that will? I think John's coming back in, but I think we're seeing it in the market that people are returning to the marketplace, that people are moving. Our sales rates are, typical at this point. And I think people are maybe getting used to the rates. So, we're talking, I had a mortgage broker tell me the other day that at 4, it's $40 a thousand on a loan. Their business is selling money, so they talk about it that way. It's at 6.7, it's $67 a thousand. So if you think about, how to what you can afford, that's just the expression of cost. And $40, $67, $50. I think we're in a range where people are starting to shed that anchor of expecting 2% or 3% to return back to the mortgage markets. Hopefully.
If I may add to what Jacob said, I think if we look at these over a longer period of time, as Matt mentioned, 6-7% is actually not a bad rate.
Yeah, sure. Historically,
we are kind of spoiled about the 2, 3, 4%. One thing that I think probably worth still mentioning that we talked about in our last call is the lock-in effect of low interest rates and in the resale market. I think that's still constraining activity. It's unclear how that is going to evolve and resolve itself, but there is a big penalty for people that want to trade up or sell their home when they have such a low interest rate on a mortgage that obviously has financial implications.
I think that's exactly right, Roberto. Absolutely. What it does is that it helps prop up prices because there's less inventory on the market. Folks are not putting their homes on the block. As you said, they're not trading up. So there's going to be less inventory. We're going to see that, I think, expressed in some of in some of this quarter's release from TMLS. And so it creates a double whammy. Not only is it expensive just from an interest rate perspective to afford housing, but the housing stays expensive. So, normally when interest rates go up, a lot of asset prices kind of come down because folks can either afford less, or that's basically an alternative an alternative to investing in something risky is just putting your money in safe bonds and earning a lot of interest. And so any kind of risky investment typically goes down in price. But with something like housing, it can be different. And one of the things that's propping up prices is the lack of supply. And the fact, this lock-in effect that you were just describing, simply adds to the supply woes in housing. That's keeping prices up.
John, we were just talking about reading the tea leaves about the 10-year treasuries, and Lawrence Young's posts yesterday about expecting sixes for the rest of the summer, maybe even ticking up just a little bit. We've seen people return to the market with inventory coming back. It's twice what it was last summer, or 3 times what it was last summer. Do you want to extend that? Are you seeing people come back in the market and starting to get over the rate lock?
Well, I think in general, we've got some pent-up demand from consumers who have been in their homes or in their rentals and are really wanting to get into homes. And I think the general sense of those who are buying and returning to the market are, let me jump in before rates drop too far and pricing jumps up because of the shortage of inventory. So, consumers who understand that, I think, are more jumping in. We are seeing multiple offers, but not 10 and 20. We're seeing 2 to 5 in the hot markets or in the certain submarkets. I think people understand they can refinance if rates will fall, but clearly the Fed has sent the message that they're not going to be dropping as quickly as we had anticipated. So as that message has really kind of gotten out in the last days and week, I'm going to be curious to see if more buyers come out or whether they retreat.
Yeah, I just got the showing report. This is an example of data that we look at just kind of obsessively. Our showing report came out yesterday for March, and we had what was it, 59,000 showings were processed last month. That's a very strong number of people actually going in and walking through the store, metaphorically. So it looks like it's going to be a very busy summer for us. The affordability that we talk about, is just one aspect of the affordability formula. If affordability is not the only thing we talk about, we want to recognize that that's probably the story that's in the headlines the most, just because it's been so extraordinarily low. Because it's 71 right now in the March report that just came out, so that its median income is 71% of the income necessary to qualify for a typical house. So that's just a persistently challenging story in the country and in the Triangle in particular.
My concern is, as rates fall, which could make a home more affordable, overall pricing is going to go back up. So I'm not sure we see a simple resolution coming to that anytime soon without major economic issues elsewhere.
Sure. Well, and the other leg of that formula is income. So, I think we are seeing median income starting to tick up with this salary projection. Who wants to talk about that aspect of affordability?
I'm happy to do that. I prepared this slide. I think this dovetails really nicely with what you just mentioned about what folks are seeing in the market right now. And the purpose of the slide really is to depict visually the issue of who can afford what here in the Triangle. So what we're seeing here essentially is the required annual salary that would correspond to being able to afford a certain home size, and home size here is measured by value. So if you like, one way to read this graph is if we focus on a $350,000 home value, which is straight down the middle there of the graph. What that bar represents is the salary, the household income. So let's not use the term salary, let's use household income that would be necessary in order to be able to afford a $350,000 home. That bar says it's roughly around $90,000. So what does that actually mean, afford? So a lot of experts on affordable housing like to use a rule of thumb, and again, we have to take it with somewhat of a grain of salt. It is a rule of thumb that says that you really should not be spending more than a third of your gross annual household income on housing. And when you say housing, we're talking about all expenses that are related to housing. So in the case of ownership, we're talking about the mortgage, we're talking about the property taxes, we're talking about the maintenance, we're talking about the insurance. All of these different costs lumped together should not add up to more than a third of gross household annual income. And again, that generally is going to vary from one jurisdiction to another. That rule of thumb probably ought to be changed if we're going to be looking at Nebraska versus Manhattan. But again, viewed through that coarse lens, what we're seeing is that the median income, which is that a flat horizontal dashed line there, that's the median income in Wake County. It's just sub $100,000. That would just about get you a $375,000 home in terms of affordability. That would be the threshold. You wouldn't want as a household to buy a house bigger than that. The problem is that only corresponds to about a third of the inventory that's out there. That is, in a nutshell, the issue is that the median household in Wake County can only afford about a third of the listed homes. So 2/3 of the listed homes out there are beyond the reach of half the folks half the households, the families that might be looking for homes.
I think it will be probably important to maybe in the conversation to talk about two different markets, a multifamily market and a single family market. I think if we were to look at this graph for single family market, we would see that most of these would be on the right side of the graph where people just can't afford to buy one. So I think it's important to keep in mind that survey after survey tells us that most buyers want a single family home. So the gap between affordability and supply of affordable homes at that level, I think is probably much greater if we look at these by some market.
Yeah, Roberto, I think you're absolutely right. In constructing this graph, one is taking account of all properties. However, to your point, that 1/3 of properties there that the median household can afford in Wake County, that 1/3 is dominated by townhomes and condominiums. And so in terms of what you actually get for that money, that part's not depicted here in the graph, and that is an important thing to note.
Is this Wake County data?
The essentially, yeah, that's
Yeah, okay.
it's triangle data, which is a blend, but it roughly lines up with Wake County data.
We're finding in the market that our buyers who want single family and want to be, let's use below 400,000, they are having to drive farther. And down into Harnett County, up into Granville, Franklin, Nash, Lee, and even in those markets, we are seeing higher inventory and larger homes as well. But when we look at our averages in those markets, we're in the 3 range, or and they don't have traditionally a ton of multifamily opportunities. But in Harnett County, we are seeing a tremendous amount of townhomes under construction trying to meet price point. The challenge for a buyer who is already a lower income buyer is that means they have to spend more money in gas to commute because there is no public transportation from these farther out markets. And obviously, even within the triangle, our public transportation is minimal in a lot of areas. But that is that drive to you can afford mindset, but it doesn't meet the needs of all of our buyers, especially in the challenging lower price ranges.
Yeah, that drive till you qualify is, this flippant remark the mortgage guys use. It means sprawl, right? It means that we're just going to cut down some more trees and move productive agriculture into permanent housing just farther and farther away from the city core. Something that we talk about a lot is what's the desired outcome of all this stuff that we're talking about? And I hope it's that policymakers that we were talking about at the start of the call are going to, hear this and develop ways, like some municipalities and counties within the triangle have done better than others about, supporting density and bringing more affordable units into the city core. There's a lot of, controversial and non-controversial ways of doing that. And we're not trying to advocate for one or the other. It's just pointing out that there really needs to be continued focus on developing units that are actually affordable for people that actually need to fill the jobs that we need them to fill without having to drive, 100 miles to come into the city center.
Well, and a bright spot is some of our new investment in new industry that is going on in the triangle is pushing it out a little bit. We look at VinFast, which is really while it is Chatham County, but it's closer to Sanford and Harnett County and the outskirts of Holly Springs and Fuquay. A fair amount of those jobs are not going to be high-paying engineer jobs. They're going to be, manufacturing type jobs, and the support that's going to come around that. We might have 6,000 new jobs in the next 2 years that get created in that corridor. That is already closer to more affordable housing. Same thing with the Wolfspeed and even the Toyota battery factory, which is more the triad market, but it's the northern reach of Chatham County. We are seeing at least those steps go on. And then again, yesterday we had another announcement in Holly Springs for another $1 billion+ investment from Fuji Dialysis. Probably just butchered that, but with lots of jobs with an average $109,000 in salary. So that is nice that it's not all the jobs are not coming right into the core of RTP and core of Raleigh and Durham. But we realize our service workers still and our work and live a lot in those areas. So the challenge is not going to go away, but we had the same conversation 15 to 20 years ago, unfortunately.
If I may quickly interject, I think this is a really important conversation and exchange about the sprawl and the cost. Just to quantify it just a little bit, say, and I think this is conservative to say that you might end up spending an extra hour every day having to commute out to a home that's on the periphery. If the added costs in gasoline and childcare, et cetera, are $20, per day, then over 250 days in the year, that's $5,000. That's that's 5% of that, more than 5% of that median household salary. This is substantial.
Yeah, I just want to drive to you qualify as absolutely a thing, and it has this $5,000 kind of cost, this negativity that comes with it. There is a positive impact, and I've done a little research here with our new statistics tool. And if you look at affordability by the year built of the house, which is a new tool that we have, if you look at houses that are older, they are above the 100% affordability line. So those houses are actually affordable. They are in the area. They will require a renovation. They'll require, a rehab. But in the same way that we're pushing people out, we're also pushing people, into marginalized properties that are now going to be renovated, and because they are the ones that are affordable in the marketplace. I think that's a very, kind of nefarious but positive outcome of the rising tide, maybe.
To piggyback in those two comments, I have former students who wanted to stay in the area and they couldn't afford anything here. They went to Mebane. They couldn't afford anything there. They finally bought a fixer-up in Winston-Salem. And
there you go.
Because we can all work remotely now, at least they can. And so they only commute twice a week. And so the numbers for them actually work. So I think it's just really as we have workers that need to be present at work. For them, the housing situation is a different scenario. That people that can work remotely, that for them probably living in the periphery is more of a reality or a feasibility. So I think it's important to disaggregate the demand into these different groups. And again, right till you qualify, I think for many, especially at the high end of the market, probably is still the way to go.
Another concern we have is in the areas where we do have the older housing stock, the competition for those homes ranges from, yes, the family that can afford that, but can they afford the true renovations of it? So you get the person who's going to come in and renovate it to fix and flips, and that drives the pricing up. And then the third element that we have is in a lot of areas, we're starting to see that those older housing stock is being torn down. So while our statistics show they're hitting the market for sale, what we're not able to see is what is really happening to that same address the next 12 months. And in many cases, that price 12 months later sometimes is double or triple, or sometimes it's just up 30 or 50% because it's now been renovated.
Yeah, or it's 3 houses where it used to be one.
Exactly.
Yeah, that's something we've talked about a good bit before. How do we get that sort of longitudinal data to measure that activity? I think we've got some inbound migration stats here, but we're going to talk about insurance for a minute. These were remarkable numbers. I mean, I'm about to build a house, and I was looking at this, scratching my head, going, I think I need to break that spreadsheet back out and take a look at that insurance line item. Wow.
Yeah, it's been on the news, not only here, but in many other states. And it's something that Washington is looking at. I don't think anybody knows how to really solve this issue yet. As you probably all know, because many of you may pay homeowners insurance, flood insurance, it went up in 2022 after COVID. It went up in 2023, another 23%. And it was on the news that the industry requested a 42% increase this year. That's something that they are negotiating. Except for Florida, North Carolina has the highest premium for a typical home of the whole East Coast. And I was surprised because I thought that states further south, they would have more storm damage and stuff, but North Carolina seems to be hit hard with high premiums. And many of our residents are actually losing their home insurance. Next. And I think part of the challenge had to do with our eastern part of the state. There are a lot of storms passing by. There is the building cost inflation that came after COVID, supply chain issues, labor shortages. The insurance industry claimed that the liability part of the insurance has gone up through the roof because of medical costs have gone up through the roof. And in general, inflation has gone up that kind of hurt insurers' ability to make a profit. I did not know until recently that the North Carolina has a law that prohibits premiums 250% above what the state approved rate. They cannot issue policies with a premium above. About 41% of policyholders in our state have premiums about the state approved rate. Once they hit to 50, insurers drop them from the coverage. And so we will see as costs continue to go up and rates are not met, maybe the request for 42% maybe is an opening negotiation with the state. But as we can see, last year, Nationwide canceled 10,000 policies in Eastern North Carolina because of that. And most of these had to do with this hitting the 250% of the approved rate. One of the challenges, I think, for the insurance that we all pay is that most of the loans for home purchase are securitized by Fannie and Freddie in the secondary market. And Fannie and Freddie use a rating system for insurance coverage, and I think they are all channeled through one company, for what I understand. And there is some concern that lenders and insurance companies are passing high risk to the GSEs by approving insurance policy that has a much higher risk than the premium entails. The way it works is, let's say in some of these families in Eastern North Carolina, after the policy was dropped, the servicer has to contact the homeowner, and the homeowner is being told that either they find an insurer or that the servicer will find it for them. Fannie Mae and Freddie Mac hold the servicer responsible for the insurance coverage. So it may be costly, and they pass that cost to the borrower, which will obviously affect marginal buyers if you cannot stretch your budget to be able to buy. So this is something that is really a huge issue that we still haven't been able to address or solve with policy. This not only affects current home buyers and homeowners like us, or many of us, but also home buyers. This escrow or property taxes and insurance is bringing up the monthly payment people need to have. And if you run your budget over a year or two, those numbers may look very differently, even with a fixed rate mortgage, because your insurance costs are going to go up. Maybe at some point you will be dropped from the policy. So I mean, it's a huge, in my view, a huge consideration. And again, I'm not sure what policy-wise is going to be resolved. I think the insurance industry wants the states to co-insure the private sector and the federal government to co-insure the states. We are in an election year, is money and budgets involved, so I really am clear what's going to happen in the short term. And I'm not sure the federal government wants to get involved with subsidizing homeowners insurance, but it's kind of a tricky issue here.
That's such an enormous issue, Roberto. I know that we spend a lot of time in the real estate industry focused on flood insurance, and there's been so much movement, in Florida with the coastal control line, and as you said, the exposure in eastern North Carolina. These costs could easily, eclipse the savings that we're seeing in any kind of gradual reduction in mortgage rates, or, and against the increase in house prices with that migration that I know we're talking about. It's just something to keep an eye on for sure. I wonder if that's something we talk about at that the realtors are talking about, John. I know insurance is always kind of front burner, but have you seen those numbers?
So we had two factors in the triangle going on. One, I don't feel we're seeing the price of your typical homeowners policy jumping dramatically in the triangle. Yes, we're seeing some increases. We're seeing it, in our personal homes as well. What is interesting is that as the tax maps have been redrawn over the years, we have a lot of people who live in properties that bought those properties before the tax maps were redrawn, and for whatever reason, their mortgage companies did not come back and make them flood insurance. So now as they go to sell that home, suddenly we're having flood insurance added to property for people when I've never had flood insurance. And, we're dealing with several of those right now. So that's part of that as some people who've been in a home 15 or 20 years, and they know that they had flooding nearby, but they didn't realize or pay attention. Their home is settling in a more, a district that requires some level of it.
Yeah. Yeah. Zone A, or the farm maps, it's the flood insurance rate maps, have been so badly done over the years. They aren't redrawn very often. I can imagine being an agency having to do that and tell, 50,000 people that they're now in the flood zone. I don't think anybody wants to be in charge of that, but that's, I guess, why they have this kind of retrospective happening, that when there's a change in ownership, you discover that you're now in an exposure zone when you weren't at purchase, and there's got to be a big impact, and that's a further impact on affordability.
Yeah,
go ahead, bro.
Yeah, and I think many of our homeowners are low income, especially in flood-prone areas, and so you have a double whammy of increased insurance costs and people having kind of limited resources to cover them.
Absolutely. And then obviously in North Carolina, as you pointed out, as we get down towards the coast, they are certainly experiencing all of this and as we've continued tremendous growth in our coastal community, especially in the Wilmington and expanded area, their insurance is through the roof. I'm just amazed what people are paying.
That's an interesting stat there on this slide. $1,000 per month cheaper to rent. How's the math work on that? Is that yours, Jacob?
Yeah. I put this slide together, Matt. And this is a national, and we'll go and look at Raleigh versus other metro areas in the next slide. But this is a national view. It's from John Burns Consulting, does a lot, as you know, in the homeownership space. So you can see for the majority of the last 20 years, with the exception of the immediate aftermath of the GFC, we've had a slight to a medium premium to own a home. Now, what we mean when we say own a home here is it's the principal, the interest payments on your mortgage, it's the taxes. And we haven't talked about taxes. We don't have a slide on taxes, but that's going to be another factor that's keeping payments up, because a lot of these jurisdictions will be reassessing values over the next couple of years. And as home prices have run, they'll obviously capture those values in their assessment. So as interest rates perhaps tick down, well, you have insurance costs continuing to perhaps move upward, but you'll also have taxes go up. So this has got your PITI, so to speak. It also tries to capture the maintenance costs of owning a home. So small repairs and also replacing the roof at regular intervals and the like. So that's comparing it to the rent for a similar home. I think the home value that John Burns is using here is 80% of the median value. So if median value in Raleigh-Durham is somewhere around $400,000 right now, this would be, if you could find it, I guess, renting a $320,000 home. And so you can see we had a run up in this premium as home prices kind of went crazy before the GFC. Then we had a dramatic fall from the aftermath of GFC. But then you can see in 13 started to get pushed back up. But look at 20. So that's COVID time, right? So you can see in that late 20, October 20, from there to this goes through mid last year, absolute rocket ship. And so today, nationally, it costs you on average $1,000 more a month to service a home, to own a home and service it, than to pay the equivalent rent in the equivalent home. So if we go to the next slide, we can drill in here on Raleigh-Durham. So you can see there's pretty good range. At the top of this slide, we've got Indianapolis, where it's relatively equivalent to own a home versus to rent a home. And at the bottom, you've got Austin, where there's a 77% homeownership premium. So in other words, if the median, I'm going to make this up, but I imagine the median rental rate is probably somewhere around $2,000 a month to rent in Austin. It costs you almost $3,700 to own that equivalent home. So Raleigh-Durham, we're in the middle of that range, which good, we're not the worst. Great, but it's a 40% premium. So it's roughly $800 more expensive to own a home, to pay for that ownership of a home, than to pay for the equivalent home and renting in that home. So what's happening there? Well, one is we know we have a limited supply. So we've seen great inbound demand. So you get this appreciation in home values. This is on top. I think what's kind of crazy about this is you could say, all right, well, maybe multifamily or single family rent prices have stayed stagnant. Those have also run 7 to 10% annual increases since COVID came here. So you see this gapping out of the cost of ownership, despite the cost of renting continuing to rise pretty dramatically on its own. So it's really remarkable here. We also, for what's worth, see this reflected in the multifamily data, so the apartment data. If you look at the big REITs, if you keep back on the other slide for a second. I don't have this on the slide, but if you look at the big REITs, EQR, Equity Residential, which has been one of the big national REITs, they said only 7.8% of their move-outs in last year bought a home. That's a record low for them. So less than 1 out of every 10 people that moved out of one of their residential communities last year went to buy a home. The rest of them rented someplace else. Same on MAA, which is active here in the Triangle. 14% of their move-outs last quarter went to buy a home. That's a record low for them. Interestingly, about 3% of their move-outs went to rent a single-family home. So what they call a single-family rental industry, which is where we build on purpose single-family homes, but not for sale, but for rent. And that's one of the few areas of the commercial real estate market that we see being capitalized over the last 12 months. So what we expect to see is some softness in apartment rents because of huge amount of supply coming online in some areas of our submarkets. If you look at the South Raleigh, if you look at like South Durham, Cary, Morrisville in Raleigh, those markets are seeing deliveries last year and this year of 10x what they normally would get in a year. So that's keeping rents a bit down. We saw a 4% overall decline in rents in Raleigh, in the Raleigh-Durham area from third quarter 23 to Q4 23. So we are seeing some softness in rents. So our expectation is that gap between the cost to own and the cost to rent will continue to climb in the absence of any significant price reductions on the single family side. We don't see multifamily rents going up very strongly, and we see home prices, maintaining their value.
Jim, I think something that would be interesting is I'd be curious to know what our rent price from, say, 4 years ago, 5 years ago to now, the relationship of the rent pricing, where that's gone, because as we talk about a slight reduction, but I mean, they jumped up so much there for a couple of years in a row. And we know that incomes have not kept up with that. But that's a interesting stat that they're seeing 14% of their apartment move-outs to buy. That's a very low number.
I think it's important to me to remember that common sense would suggest that owning should be more expensive than renting. You're buying an asset. While you rent, you just rent a roof over your head. So to me, there is unless you use a more complex measure to compare the two of them, like the usual cost of capital that economy like to use, the comparisons should always tell you that owning is more expensive because you're actually buying an asset and investing in an asset, while your rent, you're kind of just buying the use of a unit for a certain period of time. So the gap hopefully can, but one of the things I think is that what is stopping people from buying is not the gap between rent and own, it's because they cannot afford to own.
Hmm.
So I'm not sure the gap is stopping people. I think when people get to a certain life cycle stage, they want to have a stable, they want to buy an asset. And I think this gap may be important on the lower end of the market, maybe when people don't have enough income. But again, to me, it's not surprising to see that it's cheaper to rent than to own. To me, that in general should be the rule.
That's a really
Perhaps not at this differential though, Roberto. I mean, that's a significant. I
Yes.
agree with you
Yes.
that there should be some slight premium, but that's a massive premium to own right now
Yeah.
versus rent. And so
Yeah.
if you're a young person, you're looking at investing, if you're looking, and I know you teach personal finance, so this is very close to your heart, to thousands of our students over the years. You have to think about, well, what do I want to invest in? And if there's that kind of premium to invest in an asset, even though it's a benefit to me because I get to live there, maybe you rent and you take that ownership and, mentality, and you put it into equities or you put it into fixed income. There are other places to build your portfolio when you have that kind of disparity between the cost and the benefit.
Roberto, I heard you mention the economic measure that would bring in other factors, things like equity creation.
Yes.
It would be fun for our project to, try and produce more holistic homeownership statistics.
Estimating the usual cost of capital, as economists like to call it, for renting and owning is actually very complicated. You need a lot of data points to make a lot of assumptions. It would be a good thing to try to accomplish that. Absolutely.
We have some new
It will give you
AI.
it will give you more of an apples to apples comparison.
Sure. We have some new resources, I think, at Triangle that we'll be talking about as the year goes on. The advances in artificial intelligence and our ability to understand these data sets in just a new way is remarkable. Some of those are kind of skunk work projects. We'll be talking about that a little bit more as time goes on. I'm excited about where we can go with that. I mentioned this chart. I'm just looking at the time Jacob had to drop, and I've been anticipating this slide in a couple of previous comments I'd probably like to cover. The inbound migration is pretty remarkable in North Carolina, and something that I know we were in the news a little bit recently. 2010 to 2020 inbound migration was something like 1.3 million, and we're going to get over 1 million in many fewer years than that in the next several. So we think we've seen growth, in the last decade. The next decade looks like more.
Yeah, this caught my eye. The state demographer issued this information earlier in the first quarter. And you're correct. If you look at the 2010s, versus what the state demographer expects would be population growth for the next 3 decades, we're actually going to see sustained high migration, mostly from other states. And I think it's a testament to the success of North Carolina to attract jobs. I think we've spoken about a couple of big projects here in this conversation. And I think that success leads to, more people coming to the state, to work and be productive. And it looks like that's going to be sustained for a long time. And that's going to have a direct impact on our need to house these people, these households that are coming here. And to the extent that we're not successful or not as successful in trying to find housing for them, that is the backdrop for higher prices for housing, both rental and homeownership, and also for the quality of living of the people coming here. So, demand for housing is not just migration, which we see here, but a bigger part of housing is also demand from the current households here that are creating other households, children moving out of their parents to live somewhere else in the state, people who share housing, like, or, young professionals in roommate situations that are already here, and then they go out and branch their own housing. So, I kind of paired that with this data, which came from the North Carolina Housing Finance Agency, which shows that in the last 10 years, our population grew about 10%, which is about a million or so people, expected to keep growing by about a million or so people. Our households actually grew by 15%. So that's the number of households that are new looking for a place to live. But our housing only increased by, less than 12%. So we've had this persistent shortage of supply. And I think that's a major reason why our home prices are stubbornly high and also keep growing faster than incomes. I think what we don't want to see is home prices growing, but not too fast or too far ahead of incomes, because that's where affordability starts to become a problem. So I think all of this past conversations we've had about the jurisdictions, policymakers, as well as the industry need to find ways to build more housing as a more lasting solution to our affordability issue, and also to give people more choices, because it's not easy to find the house that's right for you. You know, there's a shortage, and then there's also a lack of different types of houses that a changing market may want. So I think for policymakers and for the industry, this remains a big challenge, not only to dig our way out of the hole that we're in terms of the backlog, but then to prepare for what the state demographer is calling for 3 more decades of very high household creation in North Carolina.
Yeah, boy, this really quantifies that migration, and really, I know it jumped out at you for a reason. Wow, those are extraordinary numbers. I think, John, you're looking at, I think of it as the product mix on the shelf, and there's a segment that is underpopulated, which is this, below median pricing for people that are at below median income.
Mm-hmm.
And how we do that is going to determine whether we look like a highly desirable place to live, or I won't throw Atlanta or in another city under the bus there, or look like, that place that none of us want to live or even drive through. And that's the real challenge, the existential challenge that we have. I mean, this demand will be met. It will be met by, the marketplace that will do that. But they may build an environment that is not as attractive as it seems to be, and for the long term. We'd like to advocate as an industry to look at places like the Urban Land Institute and smart land policies and see where we can advocate for more of that.
Yeah, as Jacob's slides showed earlier, the lack is in the kinds of houses that the bottom half of the income distribution in our state can afford. So that's one segment that their housing needs are not being met. And how do we advocate for housing that can be priced at that level without running into issues like sprawl and long commute? How to balance that.
That's clearly the conflict,
yeah.
And we're just trying to, we're not developers, we're not builders, we're just trying to shine a light on those things where we can and make an impact. We're right at 9. Sorry, Robert.
I think it's important to look at migrants, and whether migrants would have expected higher income, the native born North Carolinians, versus migrants who have a lower income than the native born North Carolinians. I think that would make a huge difference in the market.
Yeah, I think the state demographer also had a forecast, of course, that households will become smaller because most migrant households are smaller. He is it is projected that the population will also be older. as time goes on. And also more concentrated in urban areas. So there's also a concentration effect as to where everybody wants to live. So I think that's another layer to this issue. But I think all of the impacts, the economy, interest rates, insurance rates, all of it is happening in a backdrop of continued immigration or migration into the state. And so I think that's sort of the major trend that we will have to contend with. And the way to contend with that is to find ways to produce more supply. And that's the challenge for us for, I guess, the coming decades is how to increase supply while
right
maintaining,
way.
the
Eric, I
right
saw-
way. Yeah, exactly.
I read a statistic the other day that this country produces the same amount of new supply of new houses today, housing units, so multifamily and single family housing units today as it did in 1960. And in 1960, we had half the population of today, roughly 170 million. We have 340 million or so today. So we're producing on a per person basis half of the housing that we did in 1960.
Wow.
Well, and to pick up on one of the challenges, as you said, is as our inbound, migration being a little bit older and maybe one in an urban setting. The flip side of that is what we're watching is within the core of Raleigh and Cary and Durham and even in Chapel Hill, where there is multifamily or smaller lot development going on. The pricing is through the roof on those. It is not meeting an affordable need. It is actually, and I'll use downtown Cary, they just built a beautiful new park. It's now $1 million to live in one of the townhomes overlooking that park. That a few years ago, those same townhomes pre-park being built was in the $600,000 and $700,000 range. Downtown Raleigh, we have condos, but almost all of those condos are a very high-end type condo, not meeting rank and file, first-time job, first-time home buyer markets. We're not meeting those, certainly in the condo market. And I'll touch on the condo market. I don't see long-term condos being widely regarded as a great investment because of what has gone on down in Florida and is now working its way up the coast of the additional inspections and requirements for the Homeowners Association to have these high-rise buildings. And while we don't have the salt air in the triangle market, obviously that's a mindset that's going to affect a buyer questioning whether a condo is a good investment because of the Homeowners Association exposure, where townhomes don't necessarily have that same challenge, even though they have homeowner associations.
Interesting. John, just looking at the time, do you want to, while we're recording all this, I'll cut it up later. There's there's these news articles out talking about buyer's agency and what's happening at the national level and how it's going to, be some windfall to buyers. You and I know that's not how it works. Do you want to speak to that at all and how this might, from a statistics and housing affordability standpoint?
I will. So one of the first, we've seen a lot of media go a lot of different directions with the proposed settlement. One talking about what it's going to do to house pricing. I'm going to be shocked if the settlement affects housing prices at all. That is market driven based on supply and demand. Yes, the affordability based on where interest rates for the economy, where jobs are, and also where is the psyche between the ears in somebody's mind. I mean, we watched 10 years ago, 12 years ago when we were coming out of the Great Recession, and there was people reluctant to buy a home, even though pricing was really attractive. The difference of a couple percent in what is paid by a seller. I think short term, if there's a savings there, that seller might actually end up with a little bit more money in their pocket. But long term, I think it's going to work its way out. I think this is just a hiccup in this whole process that a new way is going to be found, possibly back to similar to the old way. I think the challenge that we've got with right now is that if a seller is not offering, which we will see more of that than we traditionally have, but the seller has to understand that's a marketing fee. When they're offering to pay a buyer's agent, that means they're going to attract more buyers if they're offering to pay a fair and reasonable fee versus if they're not.
Yeah, and some of these articles have used the word like you were eliminating buyer agency commission, the payment of that. And that's in fact just changing the point at which that fee is negotiated, making it work a lot more like commercial for people, who follow our podcast and understand how that works. This is moving those negotiations around and where that conversation is held. There's some documentation changes that are going to be made. I think that buyers benefit from representation, and they pay for it because of that. And that will continue. And that, so the impact on the housing market in terms of, fees and affordability, I agree with John, will be marginal.
And our concern short term is that the mechanisms are not in place for a low cash buyer, regardless whether they're first time home buyer, regardless whether their income level is. If they have limited amount of cash available to invest in their home, how is that going to affect their ability to buy what they want to buy? Because the lending world does not really have a good process in mind and in place. But there are ways. I mean, a seller can offer concessions, and that can be used for closing costs, which would include buyer agent commission, except for in our veteran world. And obviously, we have a country that we like to support our veterans. And right now, our veterans have zero support in anything with this settlement. And while the VA is certainly exploring this, we don't know. And that announcement could come today. It could come in 6 months or a year. But at some point, the Veterans Association and administration has got to find a way to allow a veteran to participate in the buyer side commissions when needed. So part of our market is heavily veteran area, a veteran driven market. Our southern parts of Wake County down into Harnett County and certainly down into Cumberland County. Those markets will probably not see as many non-buyer agent commissions offered, but I think in other areas we will.
Yeah, it's really a challenge for the bottom end of the market and for the VA loans. Hopefully that will get resolved. It's kind of all up in the air now. We're just tracking it all and trying to be, really aware of the impact on especially the marginalized buyers and advocating for them.
Absolutely. Yeah. I think our bigger challenge is not how the commission are going to be paid. Our bigger challenge, as we've talked about before, is the lack of availability of housing and the affordability and the promise that rates could go lower and the people sitting on the sideline waiting for the rates to go down.
Well, that was a lot of information, you guys. I really appreciate everybody staying. We had a couple of professors had to go teach class, which is completely understandable as Friday gets going. Thanks, Andrea, for putting it together for us. And we're gonna have another one of these at the end of the next quarter. So that will be sometime in July, and we'll get together and see how accurate we were at seeing what was coming up. Thanks again, everybody.
Thank you.
Yep. We'll see you soon.
Okay.
Appreciate it.
Bye.